All right, excellent. I'm just going to share my screen so we can see the slides, and then I will start her up. All right, Daniela, can you see my slides?
Yeah,
All good to go?
I can see. Good.
Okay. So hi, everybody, and welcome to our webinar on the OECD's Global Minimum Tax Project in the era of President Donald Trump. Happy April Fool's Day. I'm Andrew Silverman, Bloomberg Intelligence's Senior Tax Policy Analyst, and I have with me today Daniele Margerana, who is an expert on global taxes, based in Italy, and he's going to help us understand the perspective of the EU and maybe even the rest of the world in all of this, and I'll try to offer the US perspective. So what I thought I would do first off is just sort of level set, because the concepts we're going to talk about are relatively complicated and kind of eggheady. So I'm going to summarize the OECD's Pillar 1 and Pillar 2 project, where it all came from, and Daniele is going to keep me honest. He's going to help make sure I don't miss anything, and then Daniele and I are going to try to work through what the current situation is and where we go from here. Okay, so cue the sepia filter. The U.S. didn't adopt an income tax until 1913, and that's because under the Supreme Court's reading, prior to that point, an income tax is actually unconstitutional. So the 16th Amendment comes along, and then the U.S. can adopt an income tax, and actually that happened the same year that the Constitutional Amendment came into place. But at the time, most other countries already had income taxes, and so these overlapping systems resulted in double taxation. So biggest countries in the world came together in their new international forum, which was the League of Nations at that time, and they agreed on the first multilateral tax pact on double taxation in 1923. And the U.S. at that time was the world's largest capital exporter and was willing to cede taxing jurisdiction to the source country by allowing a dollar-for-dollar foreign tax credit. At that time, the U.S. doesn't do that anymore. I think most countries don't do that. But this agreement set out the guidelines for the allocation of taxing rights amongst different jurisdictions, and to a great extent, we still use the same system today. And the cornerstone of that agreement was that business income should be taxed primarily in the country of source. So a country is able to tax its residents and businesses based on where those businesses are headquartered, where they're formed, and where the bulk of their decision makers make their key decisions. But if a company had an important base of operations in a foreign country, local headquarters, a large branch office, something like that, something physical on the ground, that local business gave the foreign country in which it was located the right to tax the portion of that global company's income that's produced in that jurisdiction. But in that initial 1923 agreement, there were already these budding notions that the OECD has now sort of expanded on in its global tax project, specifically the notion of source extended beyond just the location of the origin of the income to include also its destination, which we call today the market country. And this broader interpretation aligns with the view that wealth creation encompasses all stages from production to realization, meaning that profit can't exist without sales. But as I said, that was 1923. There was no internet. Travel was arduous. I mean, to get from the US to Europe took days on a ship. And there weren't multinational corporations as we know them today. And the idea that a company in the United States could provide real-time virtual services to people in a foreign country like Facebook does, or could sell them practically, anything from any other country, the snap of a finger like Amazon, was beyond comprehension. So source became the primary trigger of taxation, and the notion that a market country could or should also have the right to tax, that sort of fell by the wayside. And so a century later, the OECD's base erosion and profit shifting project, which they call BEPS, outlined in its 2015 explanatory statement, reaffirmed the goal of restoring confidence in the international tax system by ensuring that profits are taxed where economic activities take place and where value is created. And within the realm of the digital economy, algorithms serve as the functional infrastructure where data is the propellant. Daniele, I think, would agree with this, and they're developed in the source country and compensated through royalties, and so that sort of complicates things. And so, in the 21st century, these principles they came up with in 1923 don't really work as well as they used to. So, in 1923, a company like Standard Oil, U.S. Steel, was paying the bulk of its taxes to the United States, but was also paying a pretty large share of its taxes to countries like France and to Germany and to the UK because they had huge operations in those countries, and they were among the largest economies in the world. And a company like Google today doesn't have very many employees or offices in France or Germany, the UK, to earn income from those countries, and so there's no physical trigger to force them to pay taxes in those countries. So about a decade ago, the OECD began trying to figure out how to update that original global tax compact to improve countries' tax codes in a uniform way to sort of prevent tax evasion and tax reduction by shifting income to low tax countries or to tax havens. And in its 2015 explanatory statement for BEPS, for the Base Erosion and Profit Shifting Project, the OECD reaffirmed the goal of ensuring the profits are taxed where economic activities occur and where value is created, those sort of traditional notions of taxation. And the first round of what became known as BEPS, the OECD came up with this action plan that included sharing tax information between countries, including country-by-country reporting and limits on interest deductions. But I think, after the first stage of BEPS 1.0, I think there was a general sense that the issues that the OECD was trying to solve had not been solved completely. And so the OECD went back to the drawing board and came up with BEPS 2.0, also known as Pillar 1 and Pillar 2. So start with Pillar 1. Pillar 1 attempts to update that original 1923 League of Nations agreement by moving away from physical presence as a tax trigger. And Pillar 1 was originally intended to be a global digital tax until former Treasury Secretary Janet Yellen stepped in to try and focus the attention away from what Europe referred to as FANG, Facebook, Amazon, Apple, Netflix, and Google, to create a structure that allowed market jurisdictions to capture a portion of their income without just focusing on the digital companies. And Pillar 1 is supposed to apply to really sort of the biggest companies, those with 20 billion euros or more in global revenue per year, profit margins over 10%, and that the income over those amounts is labeled as residual profits under the Pillar 1 terminology, and they would get reallocated to countries in which major portions of a company's consumers or users are located. So taxes so if you're Google and taxes would be paid to the U.S., a portion of those taxes would be taken away from the U.S. and then reallocated to the countries in which Google makes significant amounts of its profits. So that's the main thrust of Pillar 1, and it's been referred to as Amount A of Pillar 1. And then once Pillar 1 Amount A is adopted, the plan is for countries to repeal the digital taxes they have on the books. I should say that countries like Canada has adopted a digital tax, France, Italy, other countries have adopted digital taxes, and they said once Pillar 1 is in place, they would remove their digital taxes and replace them with the Pillar 1 tax. There's also, I should say, another part to Pillar 1 called Amount B, and it would standardize transfer pricing for routine marketing and distribution functions, but that's sort of a minor part of Pillar 1. But the problem that we faced with regard to Pillar 1, Amount A, is that the only way that they can figure out how to make it work is for all countries to sort of come together and sign a multilateral treaty to get it into place. Because if every country adopts Pillar 1 in their own way, as they've adopted Pillar 2, which we'll talk about, it won't work the way that it's intended to. It has to be uniform around the world in order to prevent arbitrage. So if the U.S. fails to sign on to that multilateral treaty, if China fails to sign on to the multilateral treaty, then essentially the whole thing collapses. Well, China hasn't ratified the treaty, and I would say that effectively it can't actually be ratified in the United States because it has to be adopted by a supermajority in the Senate, and getting 66 people in the Senate to vote on anything is very, very difficult, if not impossible, both parties. So that's pillar one. It's a means of reallocating taxing rights to raise the amount of tax revenue that these market countries can bring in. And the argument has been that the United States, which would be impacted more than other jurisdictions, should be relatively ambivalent about Pillar 1 because the U.S. is a country where many of these large multinationals are located, but the U.S. is also a market country. So in theory, the U.S. should break even. Portions of its income would be taken away under Pillar 1, because it's a source country, but then it's also a market country, and so those taxes would be then allocated back to the United States. So that's pillar one. Then there's pillar two, and if you've heard anything about BEPS or the two pillars, you're probably more familiar with pillar two. That's the global minimum tax, and the goal with pillar two is to create a tax floor. Large multinationals, those with revenue over 750 euros per year, have to be taxed at a minimum 15% effective tax rate in any jurisdiction where that company carries out its activities. And Pillar 2 accomplishes this in a couple of different ways. There's the income inclusion rule that the Conoscenti referred to as the IIR. That's the top-up tax. This would give countries the ability to top up a subsidiary's tax rate to 15% if that subsidiary is not paying at least 15%, a 15% tax rate in the country in which it's located. So that's the first thing. The second thing is the undertax payments rule, or the UTPR, which allows countries that have adopted Pillar 2 to come in and apply that top-up tax when a jurisdiction hasn't adopted Pillar 2 or wouldn't apply a top-up tax on its own. And it's generally considered to be a backstop to the IIR, and that ensures a 15% minimum tax rate from the outside. Then there's the subject to tax rule, the STTR, which is the means of capturing that top-up tax revenue if a more traditional method of taxation won't work. So what it allows countries to do is get a subsidiary up to 15% by denying treaty benefits and things like withholding tax or other tax breaks that they should be permitted to have in order to sort of, raise that the tax rate up to 15%. So you may be saying to yourself, well, but like, doesn't the U.S. already have minimum taxes? We have a GILTI, the Global Intangible Low Income Tax, also like I said, which we refer to as the GILTI. The U.S. also has the Corporate Alternative Minimum Tax, and we also have the BEAT, which is in a lot of ways like the UTPR, or like the subject tax rule. But there are some major differences between what the United States has and what the rest of the world is now adopting in terms of Pillar 2, which has been referred to, another acronym, as GLOBE. So what do I mean? Well, the GILTI, which is the closest equivalent to Pillar 2, is calculated globally, importantly, not country by country, like the Pillar 2 Globe tax. And that makes a really big difference. If you're able to pool your taxes globally, then you can use your high taxed income credits to shelter your low taxed income, and that can, for many companies, reduce your effective tax rate below 15%. And the starting point for Globe is different than that of GILTI. So GILTI was designed by Americans for American companies, right? So it allows you to net out your R&D expenses, very important in the United States, but Globe doesn't do that. Globe also, Globe allows you to net out your payroll expenses, things that are more important in the negotiations for companies outside of the United States, and GILTI doesn't allow you to do that. GILTI is intended to be a tax on intangibles, so it sets aside what's known as QBI, tangible assets, and says a 10% return on this amount, this QBI, isn't taxable as GILTI. But everything else falls into the GILTI taxable bucket. Globe is more like a 15, and Globe is calculated much differently than GILTI is. Globe is taxed like a 15% tax minus a company's effective tax rate times that company's Globe income, which is adjusted for things like tangible assets, just like GILTI, and as I mentioned, payroll, but not in the same way that GILTI book income is adjusted. And I should also note that that GILTI is based on U.S. GAAP, and Globe is based on whatever accounting system that country uses to get to book income, and so those may be different in different countries. So putting all this aside, the holy grail for a country in order to not have other countries come in and top up their income tax for them is the QDMTT. That's a qualified domestic minimum top-up tax. And if a country doesn't adopt Globe but adopts something similar enough to those Pillar 2 taxes, then that country is no longer subject to UTPR. And so, the companies in that country are safe from other countries coming in and trying to top up their minimum tax rate. Unlike Pillar 1, though, importantly, Pillar 2 is actually being adopted in more than 140 countries worldwide, and that's because it doesn't require a multilateral treaty. So, so South Korea's Globe looks slightly different from France's Globe, which looks different from Canada's Globe. So, and the undertax payments rule hasn't been adopted in every country, but they all have one thing in common: they're calculated on a country-by-country basis, and they exclude payroll, but not refundable R&D credits, for example. But the fact is that because it can be adopted without a treaty, means that countries have a much easier time putting it into place, and so we've seen that that's actually happening. Pillar 1, 200 put it into place, and so all doesn't seem to have gotten us anywhere, whereas Pillar 2 is actually being put into place globally. And go ahead.
No, please go ahead with also, then I finish.
No, go ahead.
The point is, I just want to say something about the difference between, and the distance, the gap between the Globe and the GILTI. First of all, if we look at the BEPS from the kind of historical perspective, what are the BEPS? BEPS are the answer of the OECD, so the G20 at the time of Obama, still of Obama, mandate the OECD G20 inclusive framework to study some new rules to fight against aggressive taxation. And BEPS is a very large, very big rule. There are many rules for different aspects, and also for the digital businesses. The point is, let's look at the BEPS, but let's look at the BEPS as a, let's say, the OECD answer. But the point is that the US, they faced the same problem of aggressive taxation, and their answer was the GILTI, the minimum tax, and so on. What I want to say that both the US and the EU, they face the same situation, but they choose different solution. With this approach, we can understand that there may be a gap, but there are a lot of opportunity to negotiate and to find a new solution, useful for all the two countries, let's say EU and the US. This is just, and lately about the Globe, instead of talking about the mechanisms, I would like to underline that the Globe fix the floor of the effective taxation. Globe say that you have got to pay a certain percentage of taxation, nowadays is 15, let's see, in every jurisdiction. What does it mean? Globe fix the rule of a kind of fair taxation in every jurisdiction. This is useful to avoid tax arbitrage within jurisdiction, and this is really useful within the EU, because we faced tax arbitrage within the EU country member country, Luxembourg, Ireland, Hungary, and so on. I just want also to, not to talk about the mechanism, but I think it's maybe useful to understand the mechanism to explain which is the environment, which was the environment, which were the problems, and which were the solution at that time, and which could be the new solution, if any. Please.
Right, good point. Yep. And just to wrap things up, so I'm going to talk a little bit about two sort of related taxes, a proposal for a wealth tax, and the CBAM, which Europe has adopted, and then we're going to move on to the the Trump comments on the value-added tax, which Daniele is going to take us through, and then I'd like to interview Daniele a bit to get his understanding of where things might be with regard to BEPS these days. So like I said, I wanted to talk first about the CBAM, that's the EU's carbon border adjustment mechanism, essentially a carbon tax. It's not, like I said, it's not part of BEPS, but a global carbon tax was sort of on the periphery of the BEPS discussion. And so what the EU did, and it's interesting because this is from my perspective, it's a huge deal for the United States and U.S. companies, and frankly, any company outside of the EU, but we really haven't heard a lot about it. And when you do a search for companies that mention CBAM, you get essentially nothing, companies that follow with the SEC. So I find that to be very strange. Anyway, but I think we're going to hear more about it in the coming days. And honestly, I think there's a very good chance that we're going to see some type of carbon border adjustment in the United States that applies to foreign companies in the tax act the Republicans are negotiating right now. Anyway, so what the EU was trying to do was to mimic its emissions trading system for companies located outside of the EU to sort of equalize everything, right? They're applying the carbon tax to European companies, so that same type of carbon tax should apply to companies outside of the EU, so that foreign companies don't have an advantage in Europe by their polluting. And it's structured as a border adjustment, but the border adjustment is not so different from a tariff. So it seems like that might appeal to the current administration, and it applies for now only to a few different type of imports to Europe: iron, steel, cement, aluminum, fertilizers, hydrogen, and electricity. And these were the foremost carbon-intensive sectors that the Europeans thought were at the highest risk of carbon leakage. So, and I think they've discussed expanding it in the future. We'll see what happens. But actually, when you do that search for U.S. companies that are concerned about the CBAM, it's oil and gas companies, which actually aren't affected right now. Anyway, but they expect that it's going to be expanded to them. And since it's structured like a border adjustment, or in fact, I think a lot like Pillar 2, countries can adopt it all on their own. So when cement is imported from China to Portugal, Portugal can apply something like a top-up tax to make it cost about as much as EU-produced cement. And in effect, the CBAM allows EU countries to equalize, like I said, to equalize the price of imported iron, steel, cement, etc., to locally produced iron, steel, cement, and those sorts of things. And the amount of these top-up taxes are based on the cost of the EU's domestic emissions trading system allowances. So meant to equalize things.